It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk taxes, and we want to get you all queued up for tax season. I'll tell you, most of you should have most of your stuff. I will tell you that what we're talking about today is capital assets, because I think this is one of the things people have the biggest problems with about the how to sell a house. Should you inherit a house? What do you do if it's got rental property? What's long-term? What's short-term? What's the rates? What's the all that kind of stuff. So we're going to talk about that. But in between, we want to hear what you have to say. And so we want to invite you to call in 803-0930. 803-0930, star 930 on a cell phone. And I'm joined in studio with Snowy Tiffy. Hey, Tiffany Fabian.
There,
how are you?
Esther, very, very, very good. And I want to say that you're right. I had a client that came in this week, and they usually do their own return, but they inherited a house from a life estate with 4 siblings, and then they sold it to one of the siblings, and they did it on an installment sale. So
right,
yeah.
Which is a 6252. So if you have any questions, if you're having troubles with your own return, if you have questions, federal, state, join us in studio 803-0930, star 930 on a cell phone. And for those of you out of the area, our phone number is 800-616-9236, 800-616-9236. I'm Esther Gulius from EG Tax. We were going to be open tonight till 9, but the weather's so bad, I don't know. We're going to stay open as long as clients are in the office.
I woke up this morning and Chris said, I think you should get up a little earlier because it got lots of snow overnight. I said, again? You know?
Oh, I know. It's just terrible. I feel like I need a palm tree. For those of you that are listening in Florida, we need some palm trees up here in Buffalo.
Yeah, for sure.
Okay, so let's talk about, capital assets. First of all, I've noticed hardly anybody has their information from their brokers yet.
That's right.
I mean, so most of you that are wondering, aren't they supposed to have it in? What they'll do is the broker will ask for an extension to get their legal paperwork in, and so many of you probably don't even have them yet. But we want to talk about dividends. Now, one of the cool things about dividends, if they're qualified dividends, they're taxed just like stock, and they get special tax treatment. And if you're in the 15% bracket or lower, then they're 0%.
That's right. Pretty cool. So make sure you delineate and designate if it's qualified and non-qualified. And on your 1099, it'll generally outline if it's qualified or not qualified.
It does generate.
Right.
And the important thing is, for those of you that do your own return, if you take, let's say you have $1,000 in qualified dividends and you don't feel like messing around with that special computation because it is complicated, what you've done, if you're in the 15% bracket, you're overpaying by $150. So you want to make sure that if you have qualified dividends, that you do that special computation so that you don't pay at 15%, you pay at 0%.
Right. And then I also want to say, a lot of times on those dividends, there'll be foreign tax that you pay. And so you want to pay attention to that, because that's a foreign tax credit on page 2 and 1116.
And what Tiffany brings up is a really good point. On mutual funds, since they're buying and selling, that's why you have ordinary dividends, qualified dividends. Sometimes you have capital gains. Sometimes you have taxes paid to a foreign country. If that's on your sheet from the 1098 from the broker, you want to make sure you do an 1116, because that's a foreign tax credit, and that's a direct credit, comes right off your tax return. And again, if you miss that, that's money that you just left sitting at the IRS.
That's right. That's right. Yep.
So I'm Esther Gulius, the tax lady from EG Tax. We have 30 offices to serve you all over Western New York. We have offices in Florida and Arizona. If you have any tax questions, you need really good, reasonable tax help, EG Tax is open tonight. We were going to stay open until 9, but I think until 5. Next week, 9 to 9, we certainly want to help you. And if you have questions, the IRS is not taking all calls, and you might have to wait a long time, you can email us at egtax.com, and I'll be very happy to answer your questions. So why don't we go, and again, 8030930, 8030930, star 930 on a cell phone, and we're going to go to Harold in Cheektowaga. Hey, Harold, how are you?
I'm fine.
And today's the last day to get health insurance, by the way, get in the marketplace.
Harold, happy Valentine's Day, by the way.
Thank you.
What's your question?
If I buy health insurance on the New York Exchange and I elect not to take the monthly advance payment of PTC, will I still get a 1095A at the end of the year?
Yes.
Yeah, if you bought your insurance through the exchange, then they're going to give you a 1095A, and on it, it's going to say how much advanced credit they gave you. So then when you're doing your tax return, it kind of washes out and it takes a look at what you actually have in income versus what you had projected it to have and the credit that they had given you, and you might qualify for the premium tax credit. And so if you didn't take the advance subsidy that the federal government is giving and state of New York is giving, then what you'll get when you do your tax return is the possibility of if you still qualify for a subsidy, of the premium tax credit, which is a refundable credit.
So yes, Harold, you'll still get it.
I said all that to say yes.
Okay. I just wanted to make absolutely sure that in buying it on exchange, that at the end of the year I would definitely.
Well, I'm going to, Harold, the only people that aren't going to qualify for the premium tax credit are people that don't buy it on the exchange. Because the only place that you can get the premium tax credit is when you buy your insurance through the exchange.
And you'll get a 1095A
right.
because of it.
I have one other question.
Yeah.
Now that 1095A is going to allow me to do the 8962.
Okay.
Correct.
Okay. Now, does the insurance company that I buy that I elect to buy on the exchange, do they send me the 1095A or does the exchange send it?
It was the exchange. I've looked at the envelope. It comes from the exchange.
New York State. It's the New York State of Health.
My clients bring in the envelope. Yeah.
Mm-hmm.
Okay. Okay. Well, thank you very much.
All right,
It's
Harold.
helpful, and I really appreciate it.
All right. Thank you, sir. Have a great day.
Okay, thank you.
Bye-bye.
Gosh, I've actually heard a lot of good stories about the marketplace. I have a client who's 52. She's been a waitress her whole life. I just got to get this in. And for her first time ever, she's had health insurance. She went to the doctor because she found out she had diabetes, insulin-type diabetes. She had macular degeneration of her eyes. Anyway, she's feeling much better, more energy. So it was a good thing for her.
That's right. Not so much for other people, but
Right.
good for her.
Yeah.
And I'm glad for that. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Love to hear what you have to say. We're going to take a short break, and we'll be back with your calls on the other side.
That's Bee Gees.
Yes, that's the Bee Gees.
Ding, ding.
So that's one. Yes. He's going to do something like Perry Como later for me. I'm Esther Gullius, the tax lady from EG Tax. We want to help you to do your taxes. We sure want to help you to do it right. We want to help you to save money. Love to hear your phone calls, 8030930, 8030930, star 930 on a cell phone out of area, 1-800-616-9236, 616-9236. And if you want to call from like Toronto or Florida or Arizona, love to hear what you have to say. And
Georgia.
And Georgia. Yeah, that's right. We got Larry from Georgia. All right, we're going to go to the phones and talk to Chris. Hey, Chris, how you doing?
Hi, Chris. Hi, Esther. Great. Very, very good, thanks.
What can we do for you?
Well, my husband and I have my sister living with us, and we have claimed her as a dependent.
Okay.
She does not work, so she does not have any earned income.
Mm-hmm.
And I find on this year's taxes, it asks, does everyone in your household have health insurance?
That's right.
Which my husband and I do. My sister does not.
All right.
So I was wondering Well, do we need to? Should we stop claiming her? As
Okay,
a
all right.
dependent?
So here's the thing. Everyone in your health household, your health insurance household, has to have insurance. And that's determined by the dependents on your tax return. So when you claimed your sister as a dependent on your tax return, that meant that she was in your health household. So you have to, she has to get health insurance. Now, if she has no health insurance, you can sign up today. She gets Medicaid. So she's going to qualify for an exception when you there's this form you fill out so that you don't have to be penalized.
8965.
Right. So you're going to fill out that form. She's going to qualify for the exception because of low income, and then make sure you get her Medicaid today because it's going to be covered by the federal government and everybody else and all the people. But she gets it for free. So you claim her as a dependent, but you make sure you do the form to exclude the penalty.
Okay, 2 questions then. Does she go on that New York Health Exchange?
New York State of Health.
Okay.
And also you can use our navigator
Tim
Eliason at our Lockport office.
Right.
Is probably busier than a one-armed paper hanger today. So, but you can go on New York State of Health and you put down her income, which is 0, and they'll sign her right up and she'll have it.
Okay, and this form 8965, that's online, or I have to pick that up somewhere?
It's online. I mean, you can get it where, www.irs.gov.
Right.
You can get it online at irs.gov.
But if she's in your health household, then you have to have insurance or you pay the penalty, and so you get the exception by filling out that form.
Oh, that's what I want to know, if we would end up having to pay a penalty.
You do, right, 1% of your income.
But that's why you're going to fill out the form.
Right.
Okay. All right, and we have to do this by tomorrow?
Well,
The deadline
there's 2 things. You want to fill out the form for your tax return to not be penalized.
And the
That's
deadline
one.
is the
And the
15th.
deadline for signing up is actually, it has to get started today.
Okay. All right, I think I understand. One question, that 8965, that is filed with my tax return?
That's right, because
okay.
Because unless you do the form, they're going to charge. I don't know what you and your husband's income is, but let's say it's $50,000. They're going to assess you a $500 penalty potentially.
And then also, Chris, if you go to egtax.com, if you click on the little link that We Know Healthcare, it takes you to that New York State website to start signing her up. So just link through our site, and it's just the same place.
So the higher your income, the higher that.
That's right. That's right. And next year it goes to 2%.
Yeah.
And the year after that goes to 2.5%.
Well, okay. Well, I thank you very much.
You're very welcome,
You're
dear.
welcome.
Bye-bye.
Chris.
Thanks for calling. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone. Love to hear what you guys have to say, and we're going to go to Mr. Bob. Hey, Bob.
Good afternoon.
Good afternoon, Bob.
I'm pretty sure Congress extended where you can donate from your IRA to charity and take it off on the taxes.
That was on last year. That's correct.
But it was around the middle of December.
That's true.
Did you have to do that by the end of the year?
Yes, you did, Bob.
Is it possible?
Yep, you did.
All right, so I lost that privilege.
But and really, you got to kind of keep your ear to the ground, because right now that has not been extended, but they've been extending the extensions annually here. So
yeah.
Okay.
I thought they did. It was in our local paper.
They did, but it had to be by December the 31st.
They didn't give you a lot of time.
Okay.
Yeah. That's what I wanted to know.
Thanks, Mr. Bob.
All right.
Thank you, sir. I'm Esther Gulius, the tax lady from EG Tax. Let's see, we got Janet. Hey, Janet, how you doing? How can we help you?
I'm wonderful, thank you. I have 3 IRAs, and I was wondering, once I reach 70 and a half, do I need to take something out of each and every one of them, or just one?
Yeah, you have to take something out of all of them collectively to meet your required minimum distribution for the year. So
you can add them all up. And then you go to the chart based upon your actuarial table. You should have like 27.5 years to live. You take that total from December the 31st of the year you turn 70 and a half. You divide it by the 27.6, and that answer is what has to come out of
Each and every one of them?
No, collectively. So let's say you have an IRA that was tied up for 7 years paying 5%, and you have another IRA that's paying 1%. And obviously you'd want to take it out of the 1%.
Okay.
Pretty cool.
All right?
Okay, thank you so very much.
All right, thanks, Janet. I'm Esther Golias, the tax lady from EG Tax. We love to hear what you have to say. We wanted to talk about, I know we have Bob and Patty and Tom. We're going to get you in a minute, but we want to talk about things that people really don't understand. And one of them is selling your personal home.
Right.
Right? I had a lady that came in yesterday, actually, and she's senior. She's still working, but she has to keep working because she can't afford she can't afford to just live on her retirement.
Right.
So it was interesting. Her home is pretty much paid for, and she was thinking of selling her home. And if she sold her home, then it would be completely tax-free because she's single, and the gain is going to be less than $250,000. So that would be completely tax-free. But I said to her, has she thought about using a reverse mortgage?
Right.
And a reverse mortgage is a really great tool because in her situation, she had no heirs and she really doesn't want to work anymore. And with the equity in her house was worth about $300,000. She thought she'd be able to improve her standard of living with tax-free income.
Right.
For the rest of her life.
Which is pretty cool.
And she wouldn't have a house payment or anything. So that's something to think about. The other thing is many times people that are getting up in years think about gifting their house to their children. And that becomes a problem in the year of sale.
Right. Because when you gift it to your child, it goes back to your original basis, so that you have to calculate what it originally cost mom and dad, for instance, and then any improvements and things that they've done to increase the value, to increase that basis. So it's a lot of work to get to that basis.
Right. Well, the whole thing is, let's say mom and dad paid $25,000 for the house, and they put $25,000 in improvements. Then their cost basis is $50,000. When they gift it away to the children, it's like the kids had bought it for $50,000. So if the house is worth $200,000, that's a $150,000 gain.
Right.
So that's what happens when you gift property. Not true though if you inherit the property.
Right. It goes to the stepped-up basis. And then one other thing about the gift: if a gift is after the other one died before the other spouse, you get half the stepped-up basis. So I wanted to also throw that out there.
That's exactly right. That's exactly right. Let's go back to the phones, and we got Bob. Hey, Bob, how you doing?
Good.
What can we do for you?
Well, I turned 66 last May.
Congratulations.
Thank you. I continue to work, and I've started drawing a Social Security and a small pension.
Mm-hmm.
As a result, I've had quite an increase in my taxable income.
Mm-hmm.
And what I'm wondering is if I could use a traditional IRA to reduce the amount that's taxed.
You're very smart, Bob. I use that technique all the time. So if you don't have a qualified plan where you're working, or do you have a qualified plan where you're working?
No, we don't.
All right. So you and your spouse can contribute up to $6,500 apiece. You and she, $13,000. She doesn't have a qualified plan. She's not working, is she, Bob?
I'm single.
Oh, I just got you a wife. So anyway, you can put $6,500 into a traditional IRA. That'll do two things. It should take down your taxable Social Security. It becomes an adjustment to income, and it may get you the pension savers credit.
Okay, now that's what I thought was the case until I came across something that said in my reading here a couple of weeks ago that if you have a pension, that you're not allowed that deduction.
No, see what it means. See what it means is if you have, let's say you're working for somebody and they have a qualified plan, then that means that you're in a pension plan. Then there's limitations as to how much you can put in based upon your income. But that's why I asked you if you had a qualified plan at work. If you have no qualified plan at work, you don't even have to worry about that. You can put the whole $6,500 away.
It's not talking about a past existing.
Yeah, it's your wages up to $6,500. So yeah, it's a great tool, and you have till April the 15th to do it. So you actually can do your tax return today, send it in, and fund it anytime before April the 15th.
Thank you very much.
All right, thanks, Bob. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. So
wanted to say, you also talked about selling houses. I also had a client the other day. She had the new home buyer's credit, the one that you had to pay back, the $7,500, and she had changed life situations, drastic job change, no money, and so she sold her home. She sold it at a loss, so she didn't have to pay back the new home buyer's credit anymore, and it saved her $500.
That's true. If you're somebody that had bought a house with that first time home buyer's credit that had to be paid back, if you sell it for less than when your adjusted sales price is less than what you paid for it, you don't have to pay back the advance that they had given you.
And it really helped her situation. So some things to consider.
Now, there's a lot of rental property around here. Okay. Yep. When you sell rental property, that's not handled like the sale of a house.
Correct.
You have to take all the depreciation that was claimed and you have to add it back into the basis so that you report the sale on a 4797. So that's really not reported on a Schedule D. That's reported on Form 4797.
Correct.
So you have to handle it differently. However, if you want to get rid of your house, we got a break for this. We'll see you on the other side of Estragolius, the Tax Lady.
Do I want you? Oh my, do I?
Wow, who is that?
Honey,
oh, I have no idea.
Did I do?
Sleepy Valentine.
Do. Now that's a little before my time, Tyler. Now.
Do I need you?
Honey, do I? I'm Estragolius, the Tax Lady, nostalgically listening to old-time music from Tyler Samer. All right, we're talking taxes. I'm Estragolius, the Tax Lady from EG Tax, 8030930, 8030930. Out of the area, at 1-800-616-9236, and we've had these lovely people waiting for so long. And we got Patty. Hey, Patty.
Hi, Esther. I have a question regarding a sale of my mother-in-law's home.
Yeah.
She, a year ago, she had a stroke and went into a nursing home. And back in 2002, she had changed the deed, amended it to give the house to her 4 children. One of them was my husband. And if she didn't occupy the house for a period of 180 days, then her life estate would terminate. So they were able to sell the house and close on it yesterday. My question is the cost basis. Do I have to go back to 1955 when she bought the house?
Yep.
Or can I go to 2002?
Nope. You got to go back. You have to go back to when she bought it, plus all of her improvements. Now, Patty, when did Dad die?
79.
They were still together then, and the house wasn't gifted over then. So when she bought it in 55, and Dad would have been what they paid for it plus her improvements. Then in 79, when he died, whatever the fair market value was at the time of his death, you get a 50% stepped up basis for there. Then from 79 forward, all the improvements plus the expense of
commission, lawyer fees
of sale will give you the adjusted basis.
So the improvements that were done from 79, I can reduce the cost basis on?
No, you add it to the cost basis. So what you want to do is you want to come up with a true cost basis on the house. Let's say Mom bought it and Dad and everything. It comes to 60, and you sold it yesterday for 100. Okay, then it's a $40,000 gain. So you want to increase the cost basis to compare it against the sale price.
Oh, okay. So then the dates I'm mixed up with from 55 to 79.
Okay, so let's say in 55, Mom and Dad bought the house for $40,000. So Dad's share's 20, Mom's 20. All right. Then in 79, let's say the house was worth 60. So that means Dad's share is 30 and Mom's stays 20. Okay, so that means it's worth 50 rather than 40 because you get a 50% stepped up basis of Dad's plus all the improvements that they had made.
And then don't forget to divide it between all the other siblings.
Right.
Oh yeah, divided by 4. And then if I ever get audited to prove those receipts, which I don't think we have a lot of, is that something they would look for as receipts?
Yep. You'd have to. The burden of proof would be on you to prove everything.
Okay.
Okay.
All right.
So go through Mom and Dad's paperwork and see what you can find out.
Yeah, I will. Thank you.
You're welcome, dear. Bye-bye. Let's see. We'll go to Tom in West Seneca. Hey, Tom, how you doing?
Hey, thanks for taking the call.
Oh,
Great
my
show.
pleasure.
Quick question. I don't understand. A lot of times when people are asking about health coverage and the potential penalty, you'll suggest, well, get insured now. But how does that affect what happened in 2014?
Okay. It doesn't affect. All right. Well, first of all, you got to look at this thing in two pieces. There's the present tax return and the present penalty that may be waived. Okay, if you have the right set of circumstances. Then the future penalty, if you don't have insurance for at least 9 out of the 12 months going forward. So when I'm talking to somebody, I want to make sure that I get them out of the old, and I want to make sure I don't put them in the new.
That totally makes sense now, because that kind of may answer my follow-up question, which is, for 1 month out of 2014, I was uninsured by choice, and so I won't have any exemption or anything like that.
You still have to do the exception to penalty.
So are those penalties like a sliding scale, or is it
they're allocated by each month that you didn't have insurance. Okay? So you have to still do the exception to penalty form, unless you want to be taxed 100%. All right? But you actually will be taxed on 1/12 rather than 100% if you do the exception to penalty form.
So you're going to do a Form 8965.
I don't think I have any exception. I have no reason other than I just decided
A or B is less than 3 months.
Right. Well, the thing is, you do have an exception, because one of the exceptions is that you had insurance for more than 9 months.
So you do have an
exception. You do have an exception.
You have to do an 8965.
I thought by exception, I thought you needed some sort of qualifying excuse.
Well, it is. You had insurance for more than 9 months.
And
that's your excuse. I want to know what your excuses are, Tom. That's your excuse.
You know what? No, it doesn't sound like one that you would agree with. I'm just electing to self-insure. That's
no.
She's joking.
I'm only kidding. I'm just kidding.
She's joking.
Tom, I'm actually in your corner. My job is to make sure that people don't get hit in the head, right? I want to make sure I help people. Do I agree with everything? Not really.
No, I hear you. And then, so I'm technically right now, maybe not for all of 2015, but right now I'm also electing to self-insure or be uninsured. But it sounds like that 1 month that I was uninsured for 2014 may bump me up to the 2% for a penalty for 2015 rather than the...
No. You're not going to have any penalty on your 2014 return, sounds like, for not having insurance.
Oh, right. Good point. As long as I file that form.
Right. Now, here's the thing. For 2015, though, if you self-insure, that means you have no insurance.
That's right.
All right. So that means this year you'll get a 2% penalty, and you'll have no exceptions.
Unless you're a lower income person, and
right. But it sounds like Tom just, like he says, he just morally believes it's not right.
No, it's not. Honestly, it's not. It might be one that many agree with or find foolhardy, but it is a financial decision. I'm looking at. I'm judging whether or not I have any chronic conditions. I don't, and I guess I'm rolling the dice. So let me do my cross here.
Okay, but now here's the thing. I don't know what your financial situation is, but maybe you would qualify for an exception based upon your financial situation. For instance, one of the exceptions is that your health insurance is going to be more than 10% of your household income.
And I've been finding a lot of people fit that criteria, and they're avoiding the penalty because of that.
So, I mean, that's another penalty. You don't have to get insurance if the lowest amount of qualified health insurance is more than 10% of your household income. So, if your household income is $40,000 and the lowest insurance you can get is $43,000, you're out. You got a exception to penalty.
Gotcha.
Okay.
All right, gang. Thanks so much for your help.
All right. Thanks, Tom. Let's see. We're going to go to Rose. Hey, Rose, how you doing?
I'm good. I think I screwed up listening to you. I think I screwed up a few years ago.
Maybe we can fix it.
Yeah, maybe. I hope so. My husband and I transferred the deed of our house, I guess, over to our 3 children.
Okay.
And we have life use of the house.
Mm-hmm.
At least we did until he passed away 2 years ago.
Ah.
Now, does that make a difference as far as them having to pay taxes on it?
Well, because you gifted the house prior to his death, your children won't get a stepped up basis because the gift was given before he passed away. Now, I have said to people, why don't you ungift the house? Have the kids give you back the house.
That's what I was wondering. They could do that, and that would.
Well, then now, but here's the roll of the dice. Let's say that you gift the house back to the kids, which would mean that it's now your house again. If you don't go into a nursing home and you just let it go through the estate and the children inherit it, they get the fair market value at the date of your death, which would mean that they won't pay any taxes at all. But the conundrum is, in the event that you become ill and you have to go into a nursing home, then that asset is still at risk. And that's where people have to really think long and hard, because to save $5,000 in taxes, are you going to lose a $150,000 asset?
Okay, but now, I own this house for over 40 years.
No, but go on.
And say it was, worth $45 when I bought it, but now it's worth over $300,000.
Right.
So now they would have to pay taxes on what, $260?
No, but let's just say that that it was a $260,000 gain. All right, and if the kids are in the 15% bracket or less, they're going to. How many children do we have?
3, and they make a pretty good living.
Okay, so let's say that they have to pay 20%, and so they'd have to pay $52,000 in taxes. 1 month in a nursing home, 6 months in a nursing home is going to be more than that. So that's what you have to wrestle with, Rose, because they may save the taxes, but they may lose the equity in the house because of the nursing home situation.
And Rose, did you do the life estate prior to your husband's passing or after? I think
it was before.
You mean that we have? We're able to life use in the house?
When did you do that?
Prior
to his passing. That's what I thought. Okay. So,
okay.
Yep.
So you know what I'd suggest, Rose? Maybe you want to call us and just talk it over, or go talk to your attorney, because the taxes you pay, your children would pay, if we all had a crystal ball and life was perfect and we know exactly how we're passing out of this world, you could make a perfect plan. But it's risk and reward. And the risk is that they may pay taxes. The reward is you might not losing it in a nursing home. If you don't go into a nursing home, then the kids say, gee, I wish Mom wouldn't have given it to us. I don't think there's a perfect answer.
Well, what kind of taxes would they have to pay on?
Well, if it were a $260,000 gain, and if they were all over the 15% bracket, it would be about $50,000
combined.
Yep.
Okay.
Okay.
Thank you so much.
Thank you, dear.
All right.
Bye-bye. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break. We'll see you on the other side.
Flying too high with some gal in the sky
is my idea. I get a kick out of you. Now, who is that?
Thank you, Esther.
I get a kick out of you.
Frank Sinatra?
That it? Isn't that Frankie? All right. Well,
I'm too for whatever.
Yeah, you are. I'm Esther Gulius, the tax lady, and we really aren't talking about music. We're talking about about taxes. Now, I will tell you, if you have questions, if you're somebody that's thinking of gifting houses and you don't know what to do, EG Tax is here to help you, because it's complicated and there's no easy solution, and we want to lay it out, and then you can make an educated decision. Just like the lady say, an educated consumer is our best customer. All right, let's go back to the phones. We talked to Adam. Hey, Adam, how you doing?
Oh, pretty fair considering the climate.
What climate? You mean the sunny Buffalo weather, the palm trees blowing? Yes, sir, Bobby.
This is known as the Miami of the North.
It is, yes.
I'm calling from my igloo.
Yes, sir. What can we do for you?
I wonder, I have two questions. One is, if one were to win a lottery, they take all those taxes off, but if you if you make a lot of contributions as a result of this, will they say, supposing you won $1 million, and you contributed $300,000 to your church from that, would that affect the what?
I mean, would it offset the winning? Would it offset the gains?
Yeah.
Right. Yeah. The one is income. On the left-hand side, you got the income column, and on the right-hand side, you got the itemized deduction column. So yes,
but is
the
he going to get AMT or?
No, he would not for charity.
So if you won $1 million, they might give you $700,000, if you know what I mean.
Yeah, right.
Now,
you mean after taxes? So then,
would you take the $300,000 out of the $700,000?
No,
out of the million?
Out of the million.
So therefore, they'd have to return.
That's exactly right, and that's why
a little more.
That's why people get tax refunds, Adam. That's exactly the way it works on your income tax. They take the money out and they give it. Yeah,
I'm sorry.
That's all right.
The other question has to do with property taxes.
Yeah.
If one were to contribute a piece of property to the church for them to realize that at the end of your life, and meanwhile you continue not to use it, but rather to just keep it up. First of all, would you be able to reduce your? Would you be able to claim the cost of the house or the property, I should say? Would you be able to use that as a deduction? Not as. I'm sorry.
Charity, you mean?
Okay. Here's the deal. I know what you're getting at. All right. If you give any appreciated property or stocks to a charity, all right, and if it's done through a charitable remainder unit trust, all right, that's what a CRUT is. That's where you get to utilize it, and then upon your death, it's given. At the time of that you named it through the charitable remainder unit trust, you get to take it as a charitable deduction on your Schedule A. And you get it at the fair market value, not at what you paid for it.
Well, yes, but meanwhile, say you live another 10 years, whatever it is. During those 10 years, if the property is still, it's going to belong to the church.
To the church, right?
But meanwhile,
you get to use it. Yeah,
you get to use it.
That's right. That's how it works.
But the only thing is, you wouldn't be paying property taxes during that time. That's the idea. Would you still have to pay property taxes?
I believe you do because it's upon your death that they get it. In the meantime, you get to utilize it.
Well, what if you don't utilize it? If you simply
well, you know what, Adam?
You keep it for the church, and you keep it up for them, but you don't use it.
It doesn't make any difference. You get the tax deduction on the date that the CRUT did it, right? And then it's a fair market value. Okay. Well, anyway, that was interesting. That's true. And we're going to go to that was interesting. Hey, Marilyn, how you doing? This is Esther. Hello, Marilyn.
Oh, hi, Esther. Thank you for taking my call.
Thank you. What can we do for you?
I've been retired from the state of New York, and I've always gotten health insurance, and I don't see anything on my 1099 that indicates that I have it.
That there is nothing right now on your 1099 that indicates that. I think I don't know if they're going to roll it out later, but they have a caveat. They have a couple of years.
There's a couple year phase in, and right now a lot of W-2s and 1099s aren't showing that you're covered under a qualified plan. And again, in the event that anybody should ever ask, I'm sure you could prove it, but it's not on the 1099 forms.
I can prove. I go to your place right next to the bowling alley on Transit.
Yeah.
And I have a pile in my pile of papers showing notice of my change of my net retirement system amount, and it does show how much I'm paying for health insurance.
Yeah, well, we're one of the things in taxes that I've learned is that just because you don't have ironclad proof right now, but you know you're right. And in the event they should ever say, gee, we have nothing else to do, we think we're going to bother Marilyn right now, and they write you a letter, prove it, that we know that you have that proof. So don't worry about it, Marilyn.
In other words, I shouldn't be bothered taking
You should not worry at all.
No.
Don't worry at all.
Okay, well, I enjoy your program. Thank you.
Thank you, Marilyn. Bye-bye. Have a good day. Let's see. We got Sinclair. Hey, Sinclair. This is Esther. How you doing?
Hi, how are you?
Good.
Yeah, okay, I'm just trying to ask one question. Last year, I used to work in a company, like a restaurant, stuff like that.
Mm-hmm.
But they don't pay us overtime. When you work overtime, they prefer to give you 2 paychecks.
Mm-hmm.
Okay.
And then so last month, by the end of this year, and then I received like 3 or 4 paychecks from the company.
Okay.
They sent to me that said that we throw overtime.
Okay.
They pay me all my overtime back. Do I supposed to have a W-2, W-4 from them for this year?
You should include all those W-2s on your return, no matter how many W-2s they gave you. And so you asked if you should have a W-4. You should fill out a W-4 to indicate your withholdings.
Right, a W-4 is for withholding.
No, W-4. I'm saying W-4.
W-2.
They supposed to send me W-4.
But they're giving you a lot of W-2s, Sinclair?
No, they don't. I don't get any from them yet.
All right, so they haven't given you a W-2?
No.
Do you have all your pay stubs?
Yeah, I got the pay stub, yeah.
All right, here's what you can do. If by the end of February you have not received a W-2 form from your employer, then you can make one up yourself. It's called a substitute wage and tax statement. And what you do is you add up all your pay stubs and all of the withholding that they put on there, and you basically report to the Internal Revenue Service that here's the name of my employer, here's their address. If you had their employer ID number, it would be really great. Here's my wages, here's my withholding, here's my state of New York withholding. And you submit that. It's going to have to be a paper return. Well, it actually doesn't even have to be a paper return. We can actually do it electronically. And you submit it to the IRS, and they will believe you based upon your pay stubs.
Yeah, because last year I did my tax and Easy Tax in Hamburg.
Yep.
Then I called them. I asked them, I don't have the W-2 for that company yet. If I don't get pay stub, am I going to be able to fill my tax?
Mm-hmm. Okay, well, we can do a substitute wage and tax statement. So you bring in all of those wage statements, and we'll add them all up, and we'll do a substitute W-2 form for you, and it'll work. Don't worry. And then what'll happen is the federal government goes after your employer.
Okay.
Okay?
Okay, all right. Thank you very much.
Thank you, Sinclair. Bye-bye. I'm Esther Gulius, the tax lady from EG Tax. All of our offices are open Monday through Friday, 9 to 9.
Right.
And if you, Saturdays, 9 to 5. And if you have any questions, you can go to our website at egtax.com.
Like us on Facebook.
Like us on Facebook, and we really want to help you. And I will tell you, if you have any special situation, especially now, if you're somebody that's looking for insurance and you haven't gotten it, remember, even though today is the last day to sign up for insurance through the exchange, you can still sign up next week, the week after, if you have any special life situation, like if you lost your job, if you changed your marital situation, if you had a change in your independence, or people that moved in your house, you can still get health insurance. And if you wonder why we're interested, it's because we are the people that have to report it to the Internal Revenue Service. That's why we're so keenly aware of the health insurance requirements. Until next week, Esther Gulius with Tiffany Fabian. Again, if you need us during the week, any of our offices, 80309, no, that's our phone over here, 632-7886 at corporate headquarters. Talk to you later. Have a great week. Bye-bye.